hook you checked your savings account this morning. Maybe you felt good about it, the number went up. You saved more than last month, you're being responsible, you're doing everything right. But here's what no one told you. That number going up is an illusion. In real terms, and what that money can actually buy you. You are most likely poorer today than you were a year ago. And the system doing this to you, it wasn't designed by accident. It was designed on purpose. And the people who designed it aren't hiding it. They're just counting on you not to understand it. This is the story of inflation, interest rates, and why your savings account is one of the most sophisticated wealth transfer mechanisms ever built. 030 to 130. What is a savings account? Let's start with a simple question. What is a savings account actually for? Ask most people and they'll say, safety, security, a place to keep money so it doesn't get lost or stolen. And that's true. Your money is safe in a savings account. The government insures it. The bank protects it. You can access it anytime. But here's the thing about safety. Safety and growth are two completely different things. For most of human history, people didn't need to know the difference because keeping your money safe was enough. The world no longer exists. 130 to 330, 1971, and the gold standard. Let's go back to 1971. This is not ancient history. If your parents are alive, they remember this year. On August 15th, something happened that quietly reshaped the financial lives of every human being on Earth. America decided the dollar would no longer be linked to gold. Before this moment, every dollar was theoretically backed by a physical piece of gold sitting in a vault. It was a constraint, a limit, a ceiling on how much money could exist. After this moment, there was no ceiling. Governments and central banks could now create money in quantities that were previously impossible. And they did. Slowly at first, then faster, then much faster. And every time new money enters the system, something quiet happens to the money you already have. It becomes worth slightly less. This is inflation, not the technical definition in textbooks, not the word economists use in press conferences. Inflation is simply this. More money chasing the same amount of stuff means each unit of money buys less stuff. Your savings didn't get stolen in a dramatic heist. They got diluted quietly, consistently, year after year. 330 to 530, the 2% illusion. Now let's talk about the number that everyone ignores. 2%. Most central banks around the world, including the US Federal Reserve and the European Central Bank, have an official inflation target of around 2% per year. 2% sounds small, harmless. Even politicians and economists talk about it like it's a sign of a healthy economy. But let's do the math that no one bothers to show you. If inflation runs at 2% per year, the purchasing power of your money halves in approximately 35 years. That is not a worst-case scenario. That is the official target. That is the plan. Now let's look at what your savings account is actually paying you right now. The average savings account interest rate at a major bank is somewhere between 0.4 and 0.6% annually. Some accounts pay even less. The big traditional banks, they're often paying 0.01%. Essentially nothing. So here's the equation. Inflation takes away 2% of your purchasing power every year. Your savings account gives back maybe 0.5%, sometimes less. The gap between those two numbers is what you're losing every single year. Without a single withdrawal, without a single mistake, just by doing what you were told to do. 5:30, 7 o'clock. Is inflation really 2%? But wait, is inflation actually 2%? This is where things get uncomfortable. The official inflation figure is calculated using something called the Consumer Price Index. The CPI, it's a basket of goods and services that government statisticians use to measure price changes over time. The problem is, the basket is not your life. The CPI includes used car prices, airline tickets, clothing, and electronics. Electronics get cheaper over time. So statisticians count that as negative inflation, which pulls the overall number down. But your rent doesn't work like a television. Your rent goes up. Your groceries go up. Your insurance goes up. Your healthcare goes up. Your children's education goes up. Studies consistently find that real experienced inflation for middle-class households runs significantly higher than the official CPI figure. Some estimates put it at 4-6% or more, if that's true. And the evidence suggests it is. Then the gap between what your savings account pays and what inflation actually takes is not 1.5%. It could be 3%, 4%, 5% on a savings account with $50,000. 5% annual erosion is $2,500 a year. Gone, not withdrawn, not stolen, just quietly evaporated by the mathematics of a system you never voted for and were never fully explained. 7 o'clock to 8:30. What banks actually do now? Here's the part that should make you uncomfortable. The banks know this. They're not ignorant. The people who design savings account interest rates are some of the most financially sophisticated institutions on earth. And yet they pay you 0.4%, while inflation runs at 2% or higher. Why? Because they don't have to pay you more. Here's how the banking system actually works. When you deposit money in a bank, the bank doesn't just hold it. The bank lends it out to other people, to businesses, to mortgage borrowers, to credit card holders. The bank takes your deposit and turns it into loans, charging interest rates of 8, 12, 18, 24%. Your $50,000 in savings becomes the raw material for someone else's mortgage at 6%, someone else's car loan at 9%, someone else's credit card at 22%. The bank earns the difference between what it pays you and what it charges borrowers. And since it doesn't need to compete very hard for your deposit, because you have nowhere else safe to go, it pays you as little as possible. You are not a customer in this relationship. You are a supplier. Your savings are inventory. And like any good business, the bank buys this inventory as cheaply as it can. 8:30 to 9:30. The bigger picture. Let's zoom out even further. Because this isn't just about banks being greedy. The entire system is structured this way. When a central bank like the Federal Reserve lowers interest rates, it's trying to stimulate the economy. Cheap borrowing means businesses expand, people buy houses, spending increases, growth happens. But cheap borrowing is only possible if saving is penalized. Think about it this way. If your savings account paid you 8% interest, why would you take any risk? Why would you invest in stocks? Why would you start a business? You would just save. Everyone would just save. The economy would slow down. So central banks keep rates low, which keeps savings returns low, which pushes people out of savings and into spending and investing, which keeps the economy moving. Your savings account is not just a financial product. It is a policy instrument, and the policy is designed to make holding cash unattractive. This is not a conspiracy. It's openly stated. The Federal Reserve publishes its decisions. The logic is explained in papers and press conferences, but it is never explained to you in simple language, and that gap in understanding is worth trillions of dollars to the financial system every single year. 9:30 to 10:30, the three groups. So what do people do? Most people do one of three things. The first group does nothing. They keep their money in a savings account because it feels safe. They don't think about inflation, and they discover the problem only when they try to retire and realize their savings haven't kept pace with the cost of living. The second group panics into bad decisions. They hear the cash is dying, and they put money into things they don't understand: cryptocurrencies, speculative stocks, real estate, and markets they can't analyze. And sometimes they lose more than inflation ever would have taken. The third group, the smallest group, actually understands the mechanism. They don't panic. They don't ignore it. They build a strategy around the reality of how money actually works. They keep enough in savings for genuine emergencies and short-term needs. and they put the rest somewhere that has a realistic chance of beating inflation over time. But here's the uncomfortable truth about that third group. They're not doing anything particularly clever. They're just aware of a system that everyone is affected by, but very few people truly understand. The information is not hidden. The math is not complicated. The mechanism is not secret. It just was never explained to you. 10:30 to 11:30. Why was it never explained? Which brings us to the bigger question. Why is a system that affects every working adult, every saver, every person trying to build a stable financial life? Why is this system not taught in schools? Why don't banks explain it when you open an account? There's a cynical answer and a charitable answer. The cynical answer is that confusion is profitable. A population that doesn't understand inflation keeps money in low-yield accounts, keeps spending when they should save, keeps saving when they should invest, makes decisions based on the number in their account rather than its actual purchasing power. And every one of those misunderstandings generates revenue somewhere in the financial system.